this an indication of the selling trend reversing in India's favor, or will the trend of FII selling come back and persist for longer? Well, to discuss that and other market moves, I'm now joined by Ajay Bagga. He's a market expert and commentator. Thank you very much, Mr. Bagga, for joining us this evening on ET Now.
Thank you. Thank you for calling me.
Yes, Mr. Bagga, it's always a pleasure to have you on the channel, and we'll talk about FII, Exodus and them coming back in just a bit. But let's first address the big market setup. The markets are finally rebounding. Is relief finally on the anvil, or there is more concern on the horizon? Have we bottomed out?
Difficult to say, Sumita, that we have bottomed out. But I think if you look at the macro, we are much better off than we were in September. There is a base effect that kicks in from the June quarter because FI 2025 numbers had started weakening. Corporate earnings also probably we are near to the bottom. So fundamentally we are near to the bottom. Sentimentally, is this one more leg up and then we go down and then go back again? That's difficult to really predict. But my own thinking is that by June, we should have a bottom in place, even time-wise. Price-wise, to 21,800, probably we visited a bottom price level. Now from here, markets could go down in the very short term on some event risk. But fundamentally, we are better off than we were in September.
All right, Mr. Bagga, so you're stating that, the bottom might be achieved in the next couple of months, but we are on a steady ground. Let me also ask you about the big burning question that's related to Trump tariffs. That the threat of that sword is still hanging on several sectors. So if there is a correction expected, like you're mentioning, till June is when we'll bottom out. If reciprocal tariffs by the Trump administration are announced, what kind of a correction do you expect to see in the markets, and which sectors will be most impacted?
Sectors that are, most impacted for us are gems and jewelry, electronics, electrical, intermediate goods, automobile supplies, pharma. All these are the big sectors that supply into the US. In terms of goods, we are supplying about $80 billion plus to America every year. So those are the sectors. Out of that, listed companies are maximum in the EMS segment, the electronics segment, and the pharma segment. IT is still services, so we are hoping that that will escape because that's very difficult to really put a tariff on. But goods could get some amount of reciprocal tariff. But today, the statement by the Commerce Secretary to the parliamentary panel was quite enthusing in that India is looking at a trade deal with the US. So hopefully, Trump will postpone tariffs on India and give us a chance to negotiate a trade deal. Worst comes to worst, if all the tariffs on the entire 80 billion plus of good exports come in, then it has an impact on the GDP of about 0.5% on an annualized basis. But we are not hoping that 25% will come on the entire gamut.
Right, Mr. Bagga. So you're sounding pretty bullish so far as that trade deal between India and the United States could likely happen. And that's essentially what India is also hoping for. And Mr. Bagga, on the point of electronics that you mentioned, right, I mean, electronics is one category that exports the maximum to the United States. However, the industry is actually batting for a zero tariff strategy, which essentially means that India reduces its tariffs. The United States will possibly do that as well, and that will boost domestic manufacturing, because if the United States really imposes these kind of reciprocal tariffs, which are somewhere around close to 17%, then it's not going to be that good for exports from the country. But let's move on then and look at the other obvious question. So when you talk about all of these developments and the impact that equity markets might have, where within the equity pool should exposure be raised, and where do you think there will be leadership, and where will underperformance be?
Yeah, I think we have a good chance on the defense sector. For example, a sharp correction has happened, and only yesterday the government has talked about 3 lakh crores of new defense orders being bid out over the next year. I think so. Defense sector should be coming back. Financials stay the top by a large margin, and in financials, we like the private sector banks and the NBFCs. NBFCs because wholesale funding costs are coming down. We are expecting one more RBI rate cut in April, then in June, and another one in August, September. So we are expecting 3 rate cuts from here, and NBFCs will be the beneficiaries because they are largely wholesale funded. So the flow through to them is quite fast. Same for the private sector banks. They rejig their deposits much faster than the public sector banks. So financials would be the top sector that has been there for a long time. I would say metals, personally, I don't like too much, though today, with the duty that the government brought in, the duty protection, steel majors have gone up. And with that, even non-steel, non-ferro metal producers have gone up. I'm not very convinced about it because the biggest consumer and the biggest producer, China, is in the midst of a slowdown. Chinese property market will not clear out that fast. So I think metals I would stay away from, though the market seems to like it a lot. More, I would go for domestic cyclicals, ex metals. Infrastructure is catching up a
Right.
lot. I think the government rollout of orders is catching up. That should also do well.
Yes. Absolutely, Mr. Bagga, but I'm glad that you gave out that clarification of metals not being your favorite, but of course it is a market favorite, one amongst market favorites. One final question before we let you go, and that has to be on the FII selling. That's reduced considerably if we compare, the numbers that are coming in for 17th March versus 18th March. Do you expect further pullout of FIIs, and how severe do you expect this to get the FII sellings, or will it get curbed here? Because, of the several factors that you mentioned are supporting the Indian economy.
Yeah, see, we have reasonable valuations, fiscal better, monetary better, and we have a weakening dollar. Dollar index has gone from 109 to 103. We are expecting it to go down further. Now, Trump wants a weak dollar, but his Treasury Secretary wants a strong dollar because they get the safe haven flows and the reserve currency status. So that has to get resolved. If the tariffs come in a large scale, you will see a weakening dollar because the world will start carving out economic partnerships which are ex-US. So the $3.3 trillion, Sumita, are every year exported into the US, $3.3 trillion dollars, and the US is exporting about $2 trillion dollars of goods. $800 billion dollars of services are exchanged. So it's a big chunk out of 110 odd trillion that the world produces. The US trade is about 5%. So it is big. It's not something to be frowned at, but it's not easy. Yesterday, I was reading a commentary from an auto CEO in the US. He was talking about $50 billion being needed if all the automobile production has to move within the US. They need $50 billion for factories, which will take anything from 4 to 5 years. Apart from setting up the mesh of auto suppliers, all the vendors, all the other paraphernalia that has been set up in Mexico and Canada. Some automobile parts are moving 53 times in the value chain. They start from Canada, go through the US, go to Mexico, then the car comes back, and they would have moved borders 53 times. If you have a tariff of 25% every time that crosses a border, the automobile industry is finished. So these are still posturing. What has changed is there was a Trump put in his first term where if the economy of the market started showing a semblance of rocking, he would do course correction. This time around, they have been talking down the markets. They are saying it doesn't matter. We are in a detoxification mode where the economy was dependent on government expenditure. We are detoxing the economy. I don't think it will be very politically prudential or possible to bring those value chains back into the US. But when it's organized chaos and it's insanity as a stated policy, it's very difficult then for markets. It becomes volatile. So April 2nd becomes a very big event risk, might just end with a whimper and get postponed for another 3 months. That means volatility will again get enhanced. Yesterday, if you
Right.
saw the
Right.
Bank Global Managers Survey, 55% are putting the risk of a global recession because of Trump trade wars as the biggest risk.
Right, but Mr. Bagga, Trump is saying that he's trying to save America. In fact, he says that he's trying to make America great again and, make America richer again. Well, that's the commentary, but very, very strong words that you've said as part of Donald Trump's policy. Always a pleasure having you on ET Now. Thank you very much once again for your time and sharing your thoughts on these current market moves, sir.
Thanks a lot.
All right.
If you like this video, then like, share and subscribe to ET Now.